Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello everyone, I hope all of you are preparing well for September 25 examination. In this video, we'll talk about the September 25 RTP. I'll be giving you detailed solutions of those complex questions, and I must agree that for the first time after a long period of time, ICAI has actually gone into depth of concept. Okay, so it will really test you conceptually, and if you're not conceptually clear, some of the questions may actually be appearing as bouncer even after you do it a couple of times, right? Of course, there are some issues with the RTP where they have used terms like additional paid in capital. This is a US GAAP terminology. Then they have made references to IFRS 16, which is almost similar to Ind AS 116. So the answer doesn't change, but I think ICAI should be slightly more careful, before putting out the RTP. Now moving on to the descriptive part. First one is on CFS. And these questions will actually help you revise Consolidated Financial Statement, associates. There's a lot of focus this time in this particular RTP. A Limited owns 100% of a subsidiary B Limited. It disposes 60% of its interest in the subsidiary for 360 million. This is what? Sale proceeds. And loses control of the subsidiary. The moment control is lost, we will de-recognize the assets from the consolidated balance sheet, de-recognize the liability, de-recognize the goodwill, and take what is the cash proceeds. Then difference will be taken to P&L. It will deconsolidate the subsidiary and account for the remaining 40% as an associate. Now the balance 40% as an associate should be accounted for using fair value. The equity method of accounting. At the disposal date, fair value of the retained investment is 240. So whatever you have left is 240. The carrying value of identifiable net assets of the subsidiary is 440 million excluding goodwill. This does not include goodwill. 60 million of goodwill related to previously acquired. So you have 440 million of asset, 60 million of goodwill. This is asset, this is goodwill. A Limited tested the subsidiary goodwill and long-lived asset. This long-lived asset also is a US GAAP concept. We don't say long-lived asset. A lot of questions looks to have been generated using AI, right? Prior to the disposal, and there was no impairment. There is a 4 million credit in available for sale reserve. Available for sale reserve was a terminology which was used when we did not have Ind AS 109. Okay, we used to use terms called held to maturity, available for sale. There is no concept called available for sale in Ind AS 109. This is there in US GAAP. I don't deny that. But in Ind AS or IFRS, we don't use this term. But still, looks like a lot of terminologies issues where they have forgotten to change. Okay, AFS. Now this AFS is basically our FVT OCI category. Okay, FVT OCI category. Reserve and 10 million credit in revaluation reserve. See, this will be transferred to P&L. This credit in revaluation reserve will be transferred to retained earnings. Tax consequences are to be ignored. Past journal entries for sale of 60% stake in B Limited on disposal date. Now this entry for 60% disposal of stake. Firstly what? Firstly cash received. How much is the cash received? 360 million. So cash account debit 360 million. What will we de-recognize? We will de-recognize, see it's our 100% subsidiary, so no NCI. We will de-recognize the assets 440 and 60. So 2 net assets 440, 2 goodwill 60. Then the fair value of remaining stake is 240. So investment in associate is 240, right? They have said 240. Yes, it is at 240. Then the reserve, FVT OCI reserve, you will debit that. FVT OCI reserve, OCI debit, whatever is the balance. What is the balance? The balance in OCI is 4 and 10 million in revaluation reserve. Balance in OCI is 4 and revaluation reserve debit. This will be 10. Now this revaluation reserve will be transferred to retained earnings. So this will be 10 transferred to retained earnings. Okay. This 4 will be transferred to P&L along with the gain. So what is the gain to P&L? 360 plus 240, 600 plus 4 minus 500. If you do, you get 104. So 104 will be recognized in P&L. 104 will be recognized in P&L. See, we don't have this available for sale reserve, okay. So here you will write what? OCI. Then compute the gain on 40% retained investment. Now at what price did they buy? They disposed 60% for 360, right? 240 is what is retained. Then, so here they have retained at 240. What was the asset value? 440 plus 60, so 500. 500 ka 40% is how much? 500 ka 40% is 200. What is the fair value? 240. So 40 is the gain. Gain, that is 40 million rupees. Okay. The next one, it's not non-current assets held for sale. Okay, it's maybe a part of discontinued operation, but very good question, I would say. A Limited has a wholly owned subsidiary B Limited. A Limited sells B Limited to C Limited, a listed entity, for shares in C Limited and ends up owning 75% of C Limited shares. You need to understand this carefully if you have to solve this question properly. We have what? We have A Limited. A Limited has a subsidiary called B Limited. Currently we own 100%. A Limited sold this subsidiary to C Limited. How much? Entire 100%, whatever is there, it has been sold to C Limited. So after the sale, now B Limited is the subsidiary of C Limited 100%. This relationship ceases to exist. And it ends up owning 75% of C Limited shares. So what has happened? Very unique scenario. We have sold B Limited to C Limited. What did C Limited do? C Limited issued shares to A Limited. Now A Limited holds 75% in C. C holds 100% in B. Now here two things you need to understand. First, effectively after the transaction, am I still controlling B Limited? Is A Limited still controlling B Limited? Yes, A Limited is still controlling B Limited. The effective interest has come down to 75. The effective interest has come down to 75% from 100%, but the company still controls. A was controlling B Limited, now also A is controlling. Now you may get it out, sir, is this a common control transaction? See, for common control transaction, both B and C should be under the common control of A before and after the transaction. So they have to be under common control of A before and after the transaction. Here C was not under the control of A before the transaction, so it cannot be called to be a common control transaction. Alright, so now what has happened here? Here B Limited has been sold to C Limited and B Limited is controlled 100% by C. A controls C, so A is still controlling B. So actually there is no disposal. B continues to remain the subsidiary of A Limited, and now C is also a subsidiary of A Limited. Okay, this is the first thing. Second thing that you need to understand is the flow of purchase consideration. What has happened? A Limited has 100% in B. This has been given to C. C gave shares to A. Now effectively, what has A done? Effectively, A has disposed only 25% of B. A has disposed what? Only 25% of B. Okay, that's only that is the portion only which has been disposed. 75% of B still remains with A. Indirectly, because C is controlling B and A is controlling C. That's why A still has 75% control or 75% interest in B Limited. So what has been sold? Only 25% has been sold. This will be recognized as NCI, as non-controlling interest. That is the first thing. Okay, that's the first thing you need to understand. Now what about the consideration? Let us understand that. The net assets of B Limited prior to disposal are 10 lakhs, fair value 13 lakhs, and goodwill previously capitalized and not impaired is 6 lakhs. So net assets in book is how much? 16 lakhs. The carrying value of B Limited in A Limited book is 15 lakhs. So 15 lakhs is the investment amount, you can say. The carrying value of B Limited in A Limited book is 15 lakhs. So here P&L on date of acquisition is 4 lakhs, share capital is 5 lakhs, total is 9 lakhs, 15 lakhs is the cost, so 6 lakhs is goodwill. So we got goodwill that way. Okay. Investment in subsidiary 15 lakhs, net assets 10 lakhs, 1 crore, 10 lakhs, total of 1.1 crores. Share capital is given, this has been eliminated. Retained earnings 1 lakh is post acquisition. Pre-acquisition reserves 4 lakhs. Total equity has been given. Okay. The net asset of C Limited prior to acquisition of B Limited were 3,80,000. Fair value is 5 lakh. Now, why is this important? Please understand, A has acquired C. Now, A has control over C. So, 5 lakh is the fair value of net asset which we should consider for accounting. C then issued shares worth 17,50,000, which is the fair value of the consideration given for the acquisition of 100% of B, being 6 lakhs nominal value, 11 lakhs 50,000 premium, and the balance sheets are given below. So, they have given the balance sheet. This is a stupid term to be used. It is not additional paid capital, it is securities premium. The parent A had an interest in B Limited that cost 15 lakhs and has in effect swapped this for an interest in C Limited Group. In its SFS, A Limited states investment in C at fair value of consideration given 1750. NCI is determined with reference to proportionate share. Compute the gain or loss, compute the goodwill on acquisition of C. Note, C is not required to prepare CFS. Ignore the possibility that it is a reverse acquisition. So, way too much information. What is important for us to understand is the things that have moved. Now, what C did was, C issued shares worth 17,50,000 to A. For what? For getting this stake of B under C. Okay. So, basically, the fair value of B is what? 17.5 lakhs. Fair value of B is what? 17.5 lakhs. Now, what has happened here is, A has given, now you have to understand it very carefully, A has given B Limited to C. How much? 25%. So, can I say if 17.5 lakhs is the fair value of B, consideration given, who gives the consideration? Because A has now acquired stake in C also. A has acquired 75% stake in C, right? To acquire that 75% stake in C, what has A given? A has given 25% of B. So, that is 17.5 into 25%, which is 17.5 into 25%. If you do, you get 437,500. 4,37,500 worth of business has been given to C or to the non-controlling interest, because I still have 75% with me. So, what I have given is only 25%. The amount consideration that is given is only to the extent of 25%. By giving that consideration of 25%, we have acquired 75% in C Limited, right? The other way to look at it is, if you see, assume for a moment B Limited has, I have 100% stake, okay. Now, what does A have? A now owns 75% of C plus 75% of B, effectively, okay. A owns 75% of C and 75% of B. B value at 100% was how much? 17.5 million. B's value at 100% was 17.5 million. Right now, 75% of C plus 75% of B for this entire thing, what has A given? A has given 17.5 million worth of business. So, if you look at it independently, A transferred B. If you look at it independently, A transferred B. What is the worth of B? Worth of B is 17.5. A transferred B. B is worth 17.5. What did A get in return? A got 75% of C and 75% of B in return. So, basically, can I say 75% of C is equal to this 75% of B, and this is 100% of B, that is 25% of B. That is what has happened. 75% of C is equal to 25% of B. So, consideration that has been given is 25% of B, which is 437,500. If you understand this, rest of the question is not very difficult to solve. First question is, calculate the gain on disposal of 25% of B. We have transferred what? 25% of B. What does that 25% of B include? 25% of B includes we have basically transferred 10 lakhs of asset, and goodwill that is available is 6 lakhs. Okay. We are not saying fair value because we will de-recognize the book values. So, book value is what? Book value is 10 lakhs here and 6 lakhs here, 16 lakhs. Of this, 25% has been transferred to the NCI. 25% has been transferred to the NCI. Okay. So, 25% of 16 lakhs works out to 4 lakhs. What is the consideration that is received from effectively from C? See, we got 17,50,000 worth of shares. We got 17,50,000 worth of shares, but that value also includes value of B which you already had. So what we have received is 4,37,500, because out of the total 17,50,000 received, part of that represents our own business that we already have. The value for 25% that we have received is the consideration received for transferring 25% stake. We computed 437, 37,500 will be your gain that will be recognized in E. What is the goodwill and acquisition of 75%? Business that we have given as consideration 437,500. Non-controlling interest at proportionate share of net asset 1,25,000. Fair value of assets and liability acquired total 5 lakhs. Goodwill is 62,500. Existing goodwill will not be recognized. This 4 lakhs that we are saying, this is basically calculating the non-controlling interest. Calculating the non-controlling interest. We will credit non-controlling interest. We will debit this component that we have received, and balance will go off to equity. We will not touch our existing net assets and liability because consolidation will be for 100% of assets. Now, when it comes to passing the entry, what has happened in this entire transaction, please understand. A will incorporate net assets of C. A will incorporate net assets of C. So, what is the value? Fair value of net assets of C, 5 lakhs. So, entry will be actually identifiable net assets, 5 lakhs you will debit. This is very clear because we are acquiring C. Okay, that's the first thing. Then, what is the goodwill? Goodwill and acquisition of C, 62,500 will debit. Typically, what we would have done, we would have credited two things. One is NCI to NCI and to whatever is the purchase consideration. Now, what is the NCI? NCI is 1,25,000. So, to NCI we will credit 1,25,000, which you can see has been credited here. Okay. Now, what are we left? Purchase consideration. Now, purchase consideration what we have given is 437,500. Purchase consideration given is 437,500. But what actually have we given? We have given our business. Whom have we given our business to? To the non-controlling interest in B. To the non-controlling interest in B. So, what is the value of non-controlling interest in B now? See, B was, the net assets of B is 16 lakhs. Out of that, 25% will now be given to the non-controlling interest of C. That is the value of non-controlling interest. So, 4 lakhs is the non-controlling interest, and balance 37,500 represents the gain which will be credited to equity. So, to non-controlling interest in B, 4 lakhs, to equity 37,500. If you are getting confused, sir, how did we get these numbers? What you can do is, you can first pass the acquisition of C entry 5,62,500, non-controlling interest in C 125, and purchase consideration 437,500. That purchase consideration that we are giving, indirectly what we are giving is net assets of B 25% and balance gain to be recorded in equity. Okay. Now, to prepare the balance sheet, goodwill, opening balance of 6 lakhs plus 62,500. Investment in subsidiary. Now, A has investment in C, 17,50,000. C has investment in B. Sir, how does C has investment in B? C has acquired B by issuing shares of 17,50,000. Both of these will get eliminated. Net assets, 10 lakhs has given, 1 lakh has given, 380. 3,80,000 has given, 120 is this what? C Limited's fair value increase 120. Okay. Equity share capital will take only parents. The subsidiary's equity share capital will be eliminated. Then we have something, they have given something like additional parent capital, purely, what do I say? I don't have any words to say anyways. This APIs, there is nothing called API. See, 1150, why have we eliminated? This 11,50,000 will be eliminated because this is a part of purchase consideration given by C to acquire B. Okay. Now, coming to retained earnings, how do we work out? See, the closing balance as given is 9750. This includes 2,50,000 of gain on transfer of stake in B. See, in the standalone financial statement, B has sold the stake. Okay, so in standalone financial statement, we will recognize a gain of 250. But as a group, we have not yet sold the stake. We have not yet lost the control. So this 9750 is actually 95 lakhs plus whatever was this 5 lakhs. Out of that 4 lakhs is pre-acquisition. Post-acquisition is 1 lakh, which is our share. Plus, out of this 180, there is nothing in the post-acquisition. Everything is on the date of acquisition. So 95 plus 1, 96 plus. When we disposed of 25% stake, we made a gain of 37,500. So 96 plus 37,500, 9637,500, and non-controlling interest 525. This includes non-controlling interest in C and non-controlling interest in B. Okay, so that is how we'll get to the balance sheet. Slightly complicated question, I would say, but yes, a very good question which will test conceptually. And I have to admit that if this comes for the first time in the examination, it would have been really difficult. It is completely out of the box, something what we have not seen earlier, right? Then next question, H Limited purchased a 100% subsidiary S Limited for 5 lakhs at the end of March year 3 when the fair value of S Limited net asset was 4 lakhs. So a 100% was acquired for 5 lakhs, so goodwill is 1 lakh. H Limited sold 60% of its investment in S Limited, thereby losing control 675, with remaining 40% investment and significant influence. At the date of disposal, the carrying value of the net asset of S Limited excluding goodwill is 8 lakhs. So excluding goodwill is how much? 8 lakhs plus goodwill portion what they have given is 1 lakh. So 1 lakh. The fair value of the investment of the retained is proportionate to the fair value of 60%. Compute the gain on sale of 60% for the purpose of separate and consolidated financial statement. Separate is straightforward. We'll anyways look at it. For consolidated financial statement, how much did we get? We got 675. Alright. How much did we transfer? We transferred 60% of the investment. So we have retained 40%. Right. What is that 40% retention value? 40% retention is proportionate to 60%. So if 675 is 60%, 675 divided by 60 into 40 if I do, I get 450. Retention portion is how much? 450. So 675 plus 450, the total comes to 1125,123. That is the total, you can say, investment plus consideration received. And what is the carrying amount? Carrying amount is 9 lakhs. So 1125 minus 9 lakhs if we do, we get a profit, and the profit is 11 minus 9 is 225 ka profit. So sale proceeds 675, fair value retained 450, net asset disposed 9 lakhs. 100% is derecognized, gain on sale is 225 in the group financial. In the standalone financial statement, it is simple. 675 is what you transferred, cost is 3, net profit is 375. Okay, so simple one. Agriculture, again a repetitive question, there is nothing much to discuss there. Then this is again a new question which is, which they have tried to include Ind AS 102 concept along with associates and joint venture. Beta Limited has issued 2000 equity shares which are outstanding at the reporting date. On this date, Beta issues 1000 share options to its employees which can be converted into 1000 equity shares of Beta. So, who is Beta? Beta is the investee. They have issued 2000 shares which are outstanding on the reporting date. So, 2000 shares are with the public. Again, outstanding is a term used in US parlance. Okay. On this date, Beta issues 1000 share options to its employees which can be converted into 1000 equity shares of Beta. So, 1000 shares have been issued. Who issued? Beta. Grant date fair value of each option is ₹1. The options will vest over 5 years and all 1000 options are expected to vest. So, what you will do? 1000 options into 1 divided by 5 will be the expense. Beta recognizes share based remuneration of 200, 1000 divided by 5 in its P&L and an offsetting credit to equity. We all know that. Alpha Limited is an investor holding 600 shares. Out of 2000, 600 is held by Alpha. Alpha has significant influence, so they will account for it as an associate using the equity method. Alpha recognizes its shares in the remuneration expense in its P&L as a part of income from the equity accounted investee. So what does Alpha do? Because I have to account for my share of profit, Alpha is also accounting for the share based expenditure. It records offsetting credit as a reduction of its investment in Beta. So while recognizing the expense, when you recognize an expense, what happens? Your share in profit will come down, correct? Because what happens is, when you debit P&L, profit goes down, so investment value also goes down. So they are crediting investment by recording that share based expenses. At the end of the vesting period, all options vest are exercised. Exercise price is 3, face value is 1. Past journal entries in the books of beta and alpha for recording share-based expenses for the first year. So, how will we pass that entry? Share-based expenses account debit to SBP reserve. Share-based payment remuneration to shareholders equity, ESOP reserve or SPP reserve 200. What will alpha do? Alpha is recognizing its share. Now technically when we learned, we said alpha will recognize share in profit. So indirectly what we are saying, when you are recognizing share in profit, you are recognizing share in revenue, share in expenses. So they are recognizing share-based payment remuneration, they are crediting investment in associate by 60. Then fifth year it is exercised at 3 per option. So when it is exercised 3 per option, you will get 3,000 cash, reserve account debit 1,000, to share capital 1,000, to share premium 3,000, securities premium, right? Simple. Then what will alpha do? Now what happens for alpha is, you now have suddenly 1,000 new shareholders. See, earlier alpha was holding 600 shares out of 2,000. 600 shares out of 2,000 or 1,000. $600 shares out of 2,000, so they were holding 30%. Now they hold 600 shares out of 3,000 because 1,000 new shares have come in. Now we hold only 20%. There is a reduction in net assets by 10%. The stake has gone down by 10%. The share in net assets has gone down by 10%. Now what was the net asset there? Earlier, the net asset whatever is there, to that we will add whatever cash you have received. That cash will increase the net asset, correct? So if you see the question, compute the loss and dilution of shares of Beta Limited and past journal entries for the same. Beta has net assets totaling 11,000 immediately before the shares are issued. Current net asset is 11,000. We get 3 more thousand. So currently our share is how much? 11,000 into 30%. 11,000 into 30%, it is 3,300. Now what has happened? We received 3,000. Now we have 14,000 into what? 20%. This is 2,800. How much of loss to be recorded? 500 of loss is to be recorded. So the loss that is to be recorded is 500. Out of this we have already recognized 300 of loss. We have already recognized 300 of loss because periodically when the share-based payment entry was happening, we also recognized an expense and reduction in investment. So what is the balance left? Balance loss is 200, loss and dilution to investment 200 and 200. For the question on financial instrument, I will prepare a separate video so that you have more clarity because that needs a further more integrated discussion. A short discussion will not help. Then moving on to the next one, effect of changes in foreign exchange. PQR has entered into fixed price contract on 1st of February to provide an AMC worth $10,000, which is rendered uniformly throughout the year over a period of 2 years to a foreign customer, received advanced of 3,000 and the balance is to be received on 31st March of year 4, recognizes revenue at the end of each year. How should they account for the transaction where the consideration is received in advance? Now here, when advance consideration is received, how should we account for it? Because when you receive this USD 3,000 in advance, the rate will be different. At the year end, the rate will be different, and the next year the rate will be different. So how will we account for it? So what you have to do is, this advance that is received 3,000, you have to first see whether it is monetary item or a non-monetary item. Now this USD 3,000 what you have received, it's a liability, but doesn't require any payment of monetary items. You have to give services. So it is a non-monetary item. If it is non-monetary item, you will not restate. You will not restate this non-monetary item. If you will not restate this non-monetary item, then what do? This 3,000, whatever is the value, assume for a moment the value was 80. So you will say 3,000 into 80, 2,40,000 is what is received. So when you book revenue, in the first year, 10,000 is the total revenue. You will book first year revenue of 5,000. Out of that, 3,000 will be considered at 80 and balance 2,000 on the year end rate because that is the rate at which on which the revenue is being booked. So let us say that rate is 85. So 3,000 will be booked at 80, 2,000 will be booked at 85. This 2,000 that is outstanding will be restated every year. Will be restated every year till the time you receive the payment. Then next one. A Limited, whose currency is Indian rupee, has a balance of cash and cash equivalent of 2 lakhs but no trade receivable or trade payables on 1st of April. Year 2, year 3, A Limited entered into following transaction. A Limited purchased goods for resale from Europe for euro 100,000 when the exchange rate was 1 euro is equal to 105. The balance is still unpaid at 31st March when the exchange rate is 100. So what happened? You purchase at 100. Expense is booked at 105. Closing balance is 100. So there is a gain of 5. Right? 5 rupee is the gain into 1 lakh is 5 lakh. This is the exchange gain. Then A Limited sold goods to American client for 150 when the exchange rate was 85. Amount was settled when the exchange rate was 87. Here it is realized. This is unrealized. Realized gain of how much? 2 into 150, 3 lakhs. Realized gain means cash has already been received. A Limited borrowed 100,000 under a long-term loan arrangement when the exchange rate was 105, immediately converted to 1 crore 5 lakhs. Now this at the closing balance, what is the closing balance? Closing balance is 100. So here also there is a gain. What is the gain? Here there is a gain of 500,000 on loan. Now please understand, this is realized, whereas this 500 and this 500 is unrealized. So if it is unrealized gain, we will have to add back to the profit. If it is unrealized gain, we have to if it is unrealized gain, we would have added to the profit. Now we will reduce it from the profit to arrive at the cash flow. Recommend how cash flows arising from the above transaction will be reported in the statement of cash flows under indirect method. Profit before taxation 20 to 50 plus 13 lakhs. How did they get this? This is the sale minus purchase and this is the gain. 5 lakhs of unrealized gain on payables, 2 lakhs on receivables, 3 lakhs on receivables and another 5 lakhs on loan. Okay, so the total profit is 3550. Now, there are two ways to treat this unrealized gains and losses. First is your foreign exchange gain on long-term loan, 5 lakhs. This is your non-financing activity that you will adjust. Okay, that is the first thing. Second, this trade payable, whatever is the adjustment of 5 lakhs on foreign exchange, that you can adjust it here. Or when you say the increase in trade payable, see trade payable actually closing balance is now only at 100, correct? Closing balance is at 100 only, right? Closing exchange rate is 100, so closing balance will be shown at 100. So what happens is, either you can do 100 here, instead of 105 you can show 100 here and don't show this item, or show this item here and show it at 105. But for this foreign exchange gain, you will on loan you will show it here because it is coming under a separate head, right? So operating cash flow before working capital change is so much. Changes in working capital, because there is a trade payable increase and we know when the liability is increasing we will add it. Then cash inflow from financing activity as it is, net increase in cash and cash equivalents at the beginning and closing balance at the end of the period. Very simple. Okay. Then on leases, Wealth has entered into a lease agreement with a lessor for a period of 5 years with annual lease rental of 8 lakhs. There is an option at the end of the said period that the lease can be owned. Other factors to be noted is discount rate of 8%, interest rate implicit is 10%. I don't know what they meant by 8% per annum discount rate. We have to consider interest rate implicit in the lease at 10%. Wealth is reasonably certain to exercise the option to purchase the leased asset at the end of the term, and 56 lakhs is the exercise price agreed in the lease term for purchasing of land at the end of the 5th year. So what you will do, you will consider this as a part of lease payment. Therefore, the same has been considered in computing the liability. At the end of 3rd year, they exercise the option to purchase the land at 56 lakhs, market value is 75 lakhs. This is not relevant. We have paid 56 lakhs to acquire the land. This is basically will settle the lease liability. Revised discount rate, consider the interest rate implicit in the lease. Calculate the lease liability, ROU asset for the lease with the lessor. ROU is depreciated on SLM basis. So for that, it is a very simple working. Present value of lease payment of 8 lakhs factored at 10%, and at the end 56 lakhs plus 8 lakh. But sir, we exercise at the end of the 3rd year, that is subsequent. Okay. Initially, we thought we will exercise it at the end of the 5th year. So this is the present value of lease payment. This divided by 5 will be the amortization, right? Then provide the amount reflected in the balance sheet, P&L and statement of cash flow at the end of year 1. So balance sheet, ROU asset, you can calculate. Lease liability also you can calculate. Cash flow. In cash flow, what will happen? The lease payment that you make, part of that will be your interest cost and part of that will be repayment of lease liability. So in the balance sheet ROE asset, depreciation is so much, cash flow from financing activity, the lease payment 8 lakhs, lease liability closing balance and finance cost is so much. What are the accounting entries if Wealth Limited decides to purchase the lease property at the end of year 3? Now, if they decide to purchase the property at the end of year 3, then what is going to happen? At the end of year 3, you have to pay 56 lakhs. After you pay this, the lease liability will be settled off. The lease liability will be settled off. Of course, there is a provision, and they have given references of IFRS 16. Same provision we have learned in Ind AS 116 also, that if there is a change in that option to purchase, the assessment of when we will purchase, then what you will do? You will revise the discount rate. Now here, revision of discount rate is not relevant for our calculation purpose, because by paying that 56 lakhs, we will close off the liability. We will close off the liability. So what you will do? So here they have given IFRS 16, but again, Ind AS 16, Ind AS 116 also has the same thing. If there is a change in the assessment of an option to purchase the underlying asset, then you will remeasure the lease liability by discounting the revised lease payment using a revised discount rate. But we are paying 56 lakhs upfront. We will pay 56 lakhs upfront to close the liability. That is the first thing. Okay. Second thing is, they have said what are the accounting entries if Wealth Limited decides to purchase the lease property at the end of year 3. So they have purchased. They have not mentioned what happens to the future lease payment. So technically what should happen is, you should compute revised thing by saying that okay, 56 lakhs is what you are paying today, 8 lakhs still we have to pay for the remaining 2 years. Discount it and arrive at the lease liability. But in the solution what they have assumed is, they have said that we are terminating the lease. Now you may say, sir, why will we pay lease payment when the asset has been purchased? Arey, that lease payment is a part of your loan payment schedule kind of a thing. We are settling a lease liability that can continue. They have not mentioned that, if they purchase, then what will happen to the lease? The payment may continue. So in that case, there can be a different answer where you say that, okay, 56 lakhs is paid at the end of the 3rd year, 8 lakhs is paid at the end of the 4th year, and further 8 lakhs is paid at the end of the 5th year, and then compute the lease liability and do the treatment. But what they have done is, they have said, original liability is 16,16,278. So you can see the working note here what they have prepared. Opening balance, interest, payment, closing balance 61,6,278. Okay. And they have settled 56 lakhs by payment. They have settled 56 lakhs by payment. So you have settled this liability by paying 56 lakhs. The balance amount is adjusted to right of use asset. So lease liability debit 416, right of use asset 416. So whatever is the difference in the liability, that has been adjusted against right of use asset. So here they have said, since at the end of the 3rd year, lease has been terminated due to the exercise of option to purchase the lease, it is still possible that you purchase the lease and continue to make the lease payments as per the original schedule. So here that is the assumption that we are closing the lease, we are terminating the lease. Whatever is the ROU asset balance, whatever is the right of use asset balance has been transferred to property, plant and equipment, and lease liability has been settled by paying 56 lakhs. Next one, Max Limited enters into a share-based payment arrangement with its employees on the following terms. Each employee will receive 500 shares if they remain employed for a period of 5 years. It is expected that known employees are expected to leave during the 5-year period. Granted fair value is 4,000. If an employee leaves after the 5-year period but before its shares are listed, entity A has an option to purchase the shares for fair value from the employee. So if the employee leaves and if the shares are not listed, the company can buy back. On grant date, Max Limited expects to list the share in the next 3 to 5 years. This is first share-based payment plan, and Max Limited has no past practice or policy of buying back the shares from the employees when the employees leave. Neither does Max Limited expect that it will settle the awards in cash. So it is a share-based settlement. At the end of year 2, Max Limited no longer expects to list, and the employees are informed of this fact. They announce to employees that if it is not listed after 5 years and employees leave, Max will repurchase the share. Fair value of shares is 6,000. At the end of year 3, fair value is 9,000. Determine the accounting entry in year 1 to 3. What would be the treatment of the awards if at the end of year 2, Max does not inform the employees that it will repurchase the shares after a 5-year period and a listing of entities shares is still achievable, but at the end of year 6, Max has not yet listed and 2 employees leave. Max exercises its settlement choice and buys the leaving employee shares at fair value. A very interesting question. So first is, it's a share-based payment transaction. They have said that if we don't list, we will buy. Right now we are saying we will list. So there is no obligation or there is no intention, there is no expectation that it will be settled in cash. On the granted, employer accounts for the arrangement as an equity settled share-based payment because there is no present obligation to settle in cash. So, employee benefit expense 4,000 by 5 to SBP reserve for first year, second year also same entry is repeated. When they buy back, at the end of year 2, they no longer expect and the fair value is how much? 6,000 at the end of the state. So, what does that mean? What that means is you have 6,000 of obligation now. Now it becomes a liability. It is now cash settled. You have to account for it as a liability. So 6,000 divided by 5 multiplied by 2 if you do. So 6,000 by 5. So you have to account for 2,400. So now basically what happens? 2,400 is the amount that is expected to be paid to settle this particular liability, right? So it is as good as whatever was this equity that we would have issued, we are buying it back by converting that to a liability. So we'll debit the equity share-based payment reserve by 2,400 and credit the liability. So this is equity debited and liability debited. We will not account for it as an expense. Now, why are we not recognizing an expense? That could be a question. See, 2 years we have accounted for it as an equity settled transaction. Now what has happened? We are buying back our own equity. We are doing settlement of that equity by converting that to a liability. Okay. Then moving on. At the end of year 3, it is a cash settled transaction. So now what has happened? 9,000 is the expected value into 3 divided by 5. 9,000 by 5, 1,800 into 3. 5,400 is the closing balance of liability minus 2,400 is the liability already accounted for. So 2,400. What does that mean? 5,4 minus 2,4, 3,000 is the expense to be recognized. Now, second case what they said is, they have not announced and they believe that they will list in the 6th year, but some employees left and for them they have done the cash settlement. So what happens is, here you have to see, does that create an expectation in the minds of other employees that it will be subsequently cash settled? If yes, account for it as a cash settled transaction. If no, then we'll account for it as an equity settled transaction. So let's start off without wasting much of a time. First one is case scenario. As I tell, always first look at the question. What is the question asking? Question is, what would be the initial measurement of financial instrument as subscription of loan notes in Z Limited? What will be the initial amount of recognition? What would be the closing balance as subscription of loan notes on 31st March? With respect to point 2, what is the nature of the agreement? What will be the initial cost of PPE and depreciation charge? Okay, so these are the 5 questions. So largely we will focus on that only when we are doing the case. Now here, HIJ is a globally diversified business conglomerate with operations. So all of this is time wasted in examination. Only thing that is relevant is financial year ending 31st March of year 2. Now in examination, when you skim through the paragraph, you will understand that yes, this I should be avoiding to save my time. First, on 1st of October of year 1, HIJ subscribed for 40 million rupee 1 notes in Z Limited. So who subscribed? HIJ. We are working for HIJ. 40 million is 4 crores, rupee 1 loan notes, the loan notes were issued at 90 paise, means discount. So 40 million into 1 into 0.9 and were redeemable at 1.2. Okay, so redemption price is on 30th of September of year 6. Don't quickly jump and say 6 years because we are starting at year 1, 2, 3, 4, 5, 6, 5 years. So we will take 5 years of interest, okay, payable at how much? 40 million into 1 into 1.2. Interest is payable on 30th of September in arrears at 4% of par value. So interest is, this is what? This is proceeds. This is redemption. And how much is the interest? Interest is 40 into 1 into 4% every year. All of these are in million. Okay. This represents an effective annual rate of return for HIJ of 9.9%. So they themselves have given us the rate of 9.9%. The intention is to hold the loan notes until redemption. If they want to hold it, then we'll follow amortized cost method, right? So related to this, there are first 2 MCQs. Now, what is the first question? What would be the initial measurement of financial instrument as subscription of loan notes in Z Limited? Now, this is what? This is to be done at fair value adjusted for transaction cost. Okay, it's a financial asset. Now, here there is nothing on the transaction cost. What is the fair value? Unless any other information is given, the transaction price itself will be the fair value. So, 40 million into 90 paise. we will record it at what? 36 million. So first answer is 36 million. You don't need to even break your head on that, right? Then second, what would be the closing balance of financial instrument as subscription of loan notes as on 31st March of year 2? Now don't be in a hurry in the examination to directly compute 1 year's balance. They are saying 31st March. Issue what date? Issue was on what date? 1st of October. So 6 months only. So what you have to do? 36 million is the opening balance plus effective rate they have said 9.9%. 9.9% into 36 million divided by 2. So 36 into 9.9 divided by 2, if you do that, it comes to 1.782. 1.782 plus 36, if we do, we get 37.782, option number C. So option number C is the correct answer. So see, the question appears to be slightly complex, but we are able to solve it quickly by just doing a rough working here. With respect to point number 2, what is the nature of agreement? So let us come back to point number 2. On 1st April, they commenced a joint construction of a property. For this purpose, an agreement has been entered into that provides for joint operation and ownership. All the ongoing expenditure comprising maintenance plus borrowing cost is to be shared equally. So there is an equal share. The construction was completed on 30th September and utilization of the property started on 1st of January, at which time the life was estimated to be 20 years. Now here what they are saying, it provides for joint operation and ownership of the property. So we can have a joint venture. This doesn't look like a joint venture, but here they are talking about joint operation. They are just jointly constructing a property. They are not having a separate entity. So it will not be a joint venture. It has to be a joint operation. Why not jointly owned asset or jointly controlled asset? Because there is operation part as well, right? So that's why we will put it under jointly controlled operation or a joint operation. Agreement is in the nature of joint venture? No. Agreement is in the nature of joint operation? Yes. Holding subsidiary? No. Associate? No. Simple question, joint operation, right? Then cost of PP in HIJ, depreciation for G Limited in its book. So HIJ and G Limited. Now moving on, total cost of the construction of the property was 40 crores. Beside internal accruals, the cost was funded by a loan of 10 crores taken on 1st of January. The loan carries interest at an annual rate of 10%. Interest is payable on 31st December. Company spent 4 lakh on maintenance. Maintenance is not a part of our cost. All right. Now, what is the loan amount? Now, here you have to be very, very careful with the dates. Okay. It is a straightforward question. Too many dates. They said loan taken on 1st of January. When did the construction start? Construction started on 1st of April. So you should take from 1st of April. When did the construction end? Construction ended on 30th of September. So basically, on 10 crores, you have to take only 6 months of interest at 10%, that is what? 0.5 crores. So 40 crores is the cost, 0.5, total cost is 40.5. Half of that will be 20.25. So each party will record 20.25. What will be the depreciation? Depreciation from 1st of October till 31st of March into 6 divided by 12 into how many years useful life have they said? 20 years. So this into 1 by 20. So 20.25 divided by 20 divided by 2, 50625. So 0.50625 is the depreciation, right? So options, depreciation this option and 20.25. Option C and option A. Option C and option A. All right. Option C and option A. Then moving on to the next one. Now, looking at case scenario 2, slightly simpler in terms of questions, but question is lengthy. Okay, first one is, which of the following items need to be capitalized? We have to check that. Of course, abnormal, recoverable GST, these two will not be classified. One of these two will be the answer. Associate cash flow from operation, similar from one of the past RTPs. Again, there is an ambiguity in this question. Okay. Then accounting treatment for the legal action against the company on the profit that has on the loss of profit that has arisen out of the problems. Compute the amount to be charged to the P&L with respect to the production line and the balance of provision for dismantling cost carried to the balance sheet. Compute the cost of production line to be capitalized initially on 31st of May. Okay, so basically cost of production line, amount to be charged and related aspects. So let us see. On 1st of April, company began construction of a new production line. Cost relating to the production are follows. Cost of basic material, list price 12.5 less 20% trade discount 10 lakh cost. Recoverable goods and service tax incurred but not included. This will not be included. So, you will anyways remove. Employment cost of the construction staff for the 3 months till 30th June 1.2 you will include. Other overheads directly related you will include. Payments to external advisor relating to the construction, yes. And expected dismantling and restoration cost, this we have to take at present value. Production line took 2 months to make ready for use and was brought into use on 31st of May. Same question. So, in a class also we do. They have given for 3 months. So, out of this you will take only 0.8. Other overheads were incurred during the 2 month period. They included abnormal cost of 0.3. So, here you will do minus 0.3. 0.3 you will do minus. The production line is expected to have a useful life of 8 years. 8 years of useful life. FA is legally required to dismantle the plant in a specified manner and restore to its location at an acceptable standard. 2 lakhs in the cost estimate is the amount that is expected to be incurred. Discount rate is 5%. Present value is 0.68. So, what you will do? 0.2 into 0.68. So, 2 into 0.68, 0.68 into 2, you get 1.36. 1.36 will be the provision for dismantling that is included. That gives the answer to the first question, this one. Okay. Then, 4 years after being brought into use, production line will require a major overhaul to ensure that it generates future economic benefits for the second half. Estimated cost of overhaul at current prices is 3 lakhs, which means whenever we get the total capitalization, we have to split that into 2 parts. 3 lakhs for overhauling and balance part for normal cost. So, what is the normal cost that we will capitalize? 10 lakhs of purchase cost plus 10 lakhs of purchase cost plus 0.8 plus 0.9 minus 0.3 plus 0.5, 11.9 plus 1.36, we get 13.26. So, there is a question, right? Compute the cost to be capitalized, 13.26. 13.26. Okay. See, the last question can be done first because that is the base for us to start the depreciation. Then, compute the total amount to be charged to P&L in respect of production line for the year ending 31st March and the balance of provision for dismantling cost carried to the balance sheet. There are 2 things. One is 1.36 is the present value on which date? On 1st April they started construction and in 2 months they completed the construction on 31st of May, which means 10 months interest has to be provided. Okay. So, closing balance, how will we determine? Now, whether this 1.76 is correct or not, we have to check it. Okay. Cost was 13.26. So, 3 lakhs is for overhauling cost and 10.26 is for a normal cost. This has a life of 4 years. This is a life of 10 years. Depreciation will be provided for 10 out of 12. So, 3 divided by 4 into 10 divided by 12, if I do, I get 0.625. 3 divided by 4 into 10 divided by 12, I get 0.625. 10.26 divided by 8 into 10 divided by 12, depreciation here I get 1.068, 1.06875 plus 0.625 if I do, this itself is 1.69375. This is the depreciation, but we also need to see the total amount to be charged. So, we have to see the interest component also, which is 0.0567. 1.69375 plus 0.0567 if I do, I get 1.7504 rounded off to 1.76. So, that is the correct answer, option number C, 1.76 and 1.42. Now, you may ask, sir, why not 1.42 and 1.76? Because they have first asked total amount to be charged to the statement of P&L and provision for dismantling cost, right? Then, treatment for provisions and all, you can do it on your own. It's a straightforward thing. There is nothing complicated. Cash flow from operation, as I told you, it is repeated thing, but still. Net income after taxes is 122. Decrease in account receivable, we will add. Depreciation, add back. Increase in inventory, we have purchased, so less. Increase in accounts payable, we have paid less, so add. Decrease in waste payable, we have paid more. Tax charge, deferred tax, non-cash, add back. Profit from sale of land, add back. Sorry, minus. So, 120 plus 20 plus 25 minus 10 plus 7 minus 5 plus 15 minus 2 is 170. That is the answer. 170 lakhs is the answer. Now, here Now here in this question, very clearly they have not given us taxes paid, and this has been the confusion in the exam when this question was asked as an MCQ. Also in the latest previously concluded attempts also, they have not given tax paid or not paid, we don't know. Okay, so there is no information on tax paid, and accordingly we have solved it.